The biggest stock market crash in history. A quick and significant decline in stock values is what's meant to be referred to when using the term stock market collapse. The stock market's crashing is frequently the consequence of several economic causes, such as speculative buying and selling, economic bubbles, or economic panic. The stock market crash can also occur in the aftermath of an economic crisis or a significant catastrophic event. There's no official threshold for what constitutes a crash in the stock market. However, a common standard is a steep drop of double-digit percentage points in the stock index over several days. Examples of such an index include the Standard & Poor's 500 index or the Dow Jones Industrial Average, or DJIA. Safeguards are in place to reduce the likelihood of a catastrophic event on the stock market. These safeguards include trading limits and circuit breakers that can halt all trading activity for a certain amount of time if stock values suddenly drop. Hello everyone, and welcome to another video on our channel. In today's video, we're going to discuss the biggest stock market crash in history. So stay tuned to find out. Now let's start our video. The Great Crash of 1929 was a steep drop in the value of stocks traded on U.S. exchanges that exacerbated the Great Depression of the 1930s. The Great Depression lasted for around a decade and had repercussions in industrialized and non-industrialized regions. The United States stock market exploded in the middle to the late 1920s. It persisted for the first 6 months after Herbert Hoover took office in January 1929. During the famous Hoover bull market, stock prices reached unprecedented heights, and people from all walks of life, from banking and industrial tycoons to chauffeurs and cooks, rushed to brokers to put their cash or savings in securities that could later sell for a profit. Brokers on Wall Street took out loans totaling billions of dollars to fund their margin accounts. It was again showtime for the South Sea Bubble and the Mississippi Bubble. To invest in the stock market, many people liquidated their Liberty bonds and took out mortgages on their homes. In the middle of the summer of 1929, investors were carrying a total of around 300 million shares of stock on margin, which helped drive the Dow Jones Industrial Average to the top of 381 points in September. This financial house of cards was built on shaky ground, but nobody paid attention to the red flags. As the price of stocks began to fall in September and early October, speculation persisted, spurred in many cases by people who had taken out loans to purchase shares. This practice could only be maintained so long as stock prices were growing. The frantic rush to acquire equities on October 18th was followed by an equally crazy rush to dump them. A record 12.9 million shares were exchanged on Black Thursday, October 24th, as investors scrambled to recoup their losses on the first day of true panic. Several large banks and financial firms successfully bought up large blocks of shares, allowing the Dow to close by only 6 points. Despite their best efforts, they were unable to stabilize the market. If you're liking this content so far, please consider subscribing and liking the video. Now let's continue. On Black Monday, October 28th, the market dropped 12.8%, sparking new waves of fear. More than 16 million shares changed hands on Black Tuesday, October 29th. The Dow Jones Industrial Average dropped another 12%, closing at 198, for a total loss of 183 points in just 2 months. Stocks in reputable companies plummeted like shares in a Ponzi scheme, from a high of 396 on September 3rd to a low of 210 on October 29th. Such is the decline of General Electric. The stock of American Telephone and Telegraph fell by 100 points. The stock price of DuPont Corporation dropped from $217 in the summer to $80 in the winter. The stock price of United States Steel dropped from $261 to $166. The stock price of Delaware and Hudson fell from $224 to $141, and the stock price of Radio Corporation of America, or RCA, dropped from $505 to $26. At first, political and financial leaders played it off as a temporary hiccup in the market by competing with one another with words of reassurance. The business was fundamentally solid, according to President Hoover and Treasury Secretary Andrew W. Mellon, who also predicted that a tremendous rebirth of prosperity was just around the corner. The Dow almost touched 300 again in 1930, but it dropped sharply in May of that year. It took the Dow 20 more years to recover enough momentum from breaking beyond the 200-point barrier. Several causes likely caused the stock market crash. The period of rampant speculation. People who had bought stocks on margin not only lost the value of their investment, but also owed money to the entities that had granted the loans for the stock purchases. The tightening of credit by the Federal Reserve in August 1929, the discount rate was raised from 5% to 6%. The proliferation of holding companies and investment trusts, which tended to create debt, and the proliferation of large corporations were all major contributors. Well, that's all for today's video. Tell us in the comment section how this one was. I hope that you found this video interesting. If you want to see more videos like this, please consider subscribing for more. And don't forget to provide us with your valuable feedback. We'll see you in the following video with some more notable facts and stories. And until then, stay tuned.